Over the last month, the MSCI World Semiconductor Index has posted a 13% decline, marking its sharpest drop since 2022. Here, declines have been driven by, firstly, profit-taking following a strong AI-led rally with growing concerns over valuations. Secondly, China's semiconductor capabilities advancing at a faster than expected pace. And finally, concerns over circular funding. This week will be influential in terms of the outlook for the sector in the near term, with 4 of the Magnificent 7 reporting earnings. The current sell-off in US tech stocks is acting as a bearish parameter for base metals exposed to the sector like copper and tin. However, in the medium term, this provides a robust outlook for demand, with AI being viewed as a new commodity super theme. Now this week, we're focusing in on copper, with LME 3-month copper trading at just 3.4% below its nominal record highs reached in May of $14,153 per tonne. Now, at this time, we viewed record high copper prices as somewhat unjustifiable, with the rally driven largely by AI enthusiasm, unforeseen supply risks created from the Iran war, concerns over the pull of refined units into the US on Section 232 tariff expectations, alongside a wider market appetite to hold on to strategic hard assets. In reality, however, we had a backdrop of historically elevated global stocks, a forward curve in contango, anticipation of relatively balanced refined market, and a globally divergent view from speculators. However, as things stand now, the fundamental picture for copper has been tightening, with real-world tightness starting to show. Now, firstly, on the supply side, for mine production, concerns are building following El Niño-driven storms in Chile. Of course, Chile being the world's largest copper mining country. Here, while we've heard from a handful of major producers on a variety of disruptions, it does appear as though the impact is temporary and limited, for the moment, with most mines operating contingency plans. However, with this aside, Chile was already facing a second year of declining mine production after downgrading their production guidance by 2% to 5.3 million tonnes from 5.6 million tonnes previously. Now, in turn, Codelco, the largest copper mining company in the world, their chairman outlined overnight that the company will not be able to return to pre-pandemic levels in the years ahead. Now, taking a step back, pre-Chilean storms, we forecasted global mine production would be flat this year, with negative headwinds pushing spot treatment and refining charges to record low levels, with smelters outside of China facing slimming margins. Now, secondly, supply risks are mounting for above-ground stocks as well, with LME inventory having fallen to 102,000 tonnes, its lowest level since the start of the year, in turn resulting in a cash to 3-month spread for copper posting backwardations. Now, the key driver for this unseasonal period of drawdowns is twofold. So firstly, we have ongoing uncertainty over the ruling for Section 232 on US imports of refined copper tariffs. Over the first half of the year, the December to December COMEX LME arbitrage has traded between $400 to $1,000 per tonne premium, with imports into the US being underpinned. Now, we estimate at least 1.2 million tonnes of copper has entered the US since the executive order was signed for copper last year, with around 64% of global visible stocks now sitting in the US. Meanwhile, a government crackdown on tax-related practices and circular invoicing in China has since reduced copper scrap availability in the country. It's forced consumers towards refined cathode. And so in turn, domestic SHFE stocks have been pulled lower. And if we set this against seasonal smelter maintenance period in the country, it's no surprise that the Yangshan import premium has now risen to a multi-year high. And this has opened the SHFE LME import window. So with LME stocks being drawn from both the West and East, visible exchange stocks outside of the US have now fallen to their lowest level since February 2024. So looking ahead to the fourth quarter, we believe copper has the potential to challenge new record highs. Seasonal demand in China should strengthen and may receive an additional boost as Beijing accelerates fiscal spending, with less than half of this year's infrastructure budget having been deployed during the first half of the year. Secondly, if there's no announcement on Section 232 refined copper tariffs before the 1st of January implementation deadline, arbitrage opportunities could widen and support further US buying. Now, at the same time, any easing of tensions in the Middle East would improve broader risk sentiment, while the structural themes of electrification, grid investment, and energy transition continue to underpin long-term copper demand. Now, supporting all of this is the fact that visible inventories outside the US are now at multi-year lows. Now, having said this, a key risk to higher copper prices comes from the outlook for US monetary policy. Our house view is for one Federal Reserve rate hike in December, but if inflation proves more persistent, that could be brought forward to September, strengthening the US dollar and, of course, weighing on metal prices. Now, ultimately, the two themes that will determine whether copper reaches new highs are Section 232 and the Iran conflict. Our base case remains that no refined copper tariffs are announced in the near term and that geopolitical tensions gradually ease over the coming months. If that scenario plays out, we believe copper is well positioned for a bullish Q4. That said, we continue to expect the exceptionally strong draw of metal into China to begin to moderate through August, so the pace of tightening is unlikely to be maintained indefinitely.